All right, so learning objective 3 is a very important learning objective in this chapter. This is where you're going to be introduced to financial statements that you're going to be using for the rest of your life as a business person. Your book describes and gives you an introduction to 4 of these statements, which I will also review with you. But we are going to be focusing in on the very, very first 3. Okay. So not only are you going to be introduced to those statements, but you're also going to be preparing these statements as part of your homework. And this is where I was telling you that this course is time consuming. Now you're going to really understand what I mean once you sit and do your homework, because it's time consuming. It's not difficult, but it's time consuming stuff. So let's go on with our introduction to the financial statements. The very first financial statement, I think, is one of the more important ones to understand because it answers the question, did the company make a profit or a loss? And matter of fact, if you're in business, that's one of the biggest questions you have for yourself. So after this period of time has gone over, did I make a profit or did I have a loss? That's what owners really want to know about. And guess what? Only the income statement can tell us the answer to that. And they tell us the answer to that, as you'll see, by comparing the revenues, right, from that period with the expenses of that period. Now, you learned about revenues and expenses briefly in Objective 2. And you understand that revenues are directly related to what a company will sell. And expenses are related to what they have to spend in order to sell that stuff, right? Renting their office or building, paying their employees, among other types of things. All those expenses add up. The income statement gives us the answer to that. Did they make a profit or not? And you've already heard a little bit about net income, but that's basically what we're going to be focusing on in the income statement. So net income, by the way, is synonymous with the word profit. All right. So matter of fact, years ago, way back in the day, we used to call this the profit and loss statement. You can still call it a profit and loss statement. It's the only financial statement that tells you whether the company has had a profit or a loss for a period of time. The periods of time used normally are a month, a quarter, which is a 3-month period, and a year, which is a 12-month period. So those are usually how we measure profit and loss on the income statement. Question I have for you is, once we've calculated that a company has a profit, whose profit is it? In other words, who owns the profit of a business? Well, the answer is the owners. The owners own the profits of a business. They own the business. If the business is profitable, it's their profit. So if you were an owner of a business, what would you want to do with the profit? Most business owners would want to put that profit and leave that profit in the company so they can purchase more assets in order to grow the business. And when we say grow the business, we really mean sell more stuff and make it more profitable. Well, there's a specific statement that tells us what happened to the profit, how much of the profit of the company has been kept in the business for that type of reinvestment. And that's what's called the retained earnings statement. This is a statement that's done right after the income statement. And here are some other very interesting little points here. The word earnings is synonymous with the word profit, which is synonymous with the word net income, right? So you've learned about net income. Net income is the same as profit. Guess what? Profit is the same as earnings. As a matter of fact, that's what we're waiting for today on Wall Street. Apple is going to share its earnings report with everybody today at about 4 o'clock. And so when they say earnings, they really mean profits. Okay. So you see that so income is really about profit. Earnings is really about profit. It's just different names for the same thing. The word retained simply means kept in, right? So, and again, as a business owner, you would want to make sure you are keeping in some of your profits in the business so you can reinvest that in growing your business. So this statement tells us how much of the profit has been retained in the business. Retained earnings statement is a statement of how much of the profit has been retained. Well, what else can happen to the profit of a company? Well, sometimes the profit of the company is shared with the owners. In a corporation, that sharing is called a dividend. Okay, so sometimes some of the earnings or profits are distributed to owners' personal accounts in the form of a dividend. The rest is retained. The retained earnings statement will tell us about that as well. Okay. Good thing to know about these two statements, they measure the exact same period of time. The income statement's always the first one done because the first question is, did we make a profit or not? And only that statement can answer it. And this statement is done right after it, the retained earnings statement, because once you actually have a profit from your income statement, the retained earnings statement tells the story of what happened to that profit, how much of it was retained, how much of it was sent in the form of a dividend. The last financial statement that you'll be focusing on in this course is something called a balance sheet. And the balance sheet basically is a financial statement that tells us what are the assets of the company as of a particular day? What are the liabilities of that company as of a particular day? And what's the stockholders' equity in that company as of a particular day? Now, you might have noticed that I said as of a particular day 3 times, well, including that one, 4. But basically, the balance sheet is simply a financial selfie of the company at a particular day. Okay. What the assets, liabilities, and stockholders' equity are of that company on a particular day. I'll say it again, just for the hell of it. It's the third financial statement that we do. It's done after the retained earnings statement. But again, unlike the income statement and a retained earnings statement, which tells us the story of a period of time, like a month or a quarter or a year, the balance sheet tells us only about what's going on that day. So these are the 3 that we're going to be focused on that you're going to learn a lot about. The 4th one that they introduced you is important, but you will get a deeper look at it a little bit later in your studies. And that's called the statement of cash flows. And it really talks and focuses on one thing, cash, and the flow of cash. The cash can only flow 2 ways. It'll either flows in or it flows out. Right? A lot of you shaking your head like, tell me about it. Well, corporations, basically speaking, keep track of that cash flow. Where is the cash coming from, coming into the company from, and how is it being used? How is it going out? And that there's a whole chapter in the book later on that's devoted to it. And we actually take our time in looking at it in detail in managerial accounting as well. So you will get that a bit later, but that's what it is. Okay. So here you should be smiling. This is an income statement. Big smile. I would have a big smile because it's one of those smiley days to have an income statement. Is that really kind of a smile? I don't know. Maybe it's kind of a Prozac smile or something. I'm not sure. All right. So the income statement here, again, measures a period of time. And you'll see that right in the heading for the month ending October 31st. So it's only looking at the month from October 1st to October 31st. That entire month's activity is here. The business name is Sierra Corporation, which is introduced in your book and in your reading. It's a fictitious company that gives tours of the Sierra Nevada region in California. Of course, not now because it's covered in like 5 feet of snow, but in general, all right. And so they're a service business. They give tours. Tours is providing work for somebody. You give someone a tour, you're doing work with them, for them. And so the income statement will show what if Sierra Corporation was profitable for the month of October. Well, you need 2 types of accounts to see if you're profitable. The first account always you're going to be looking at are what revenue accounts does the company have? And companies can have more than one revenue account. This particular company only has one. They're a simple company. They only give tours. Their revenue account is called service revenue. This is the actual title of the account, service revenue. This is simply the type of general account revenue. Okay. So it had $10,600 of revenue, service revenue, in the month of October, right? From the time it opened on October the 1st to the time the business closed October 31st. That's the total amount of tour revenue they earned. That's good. Now they have to match that with the expenses. What expenses that they have to take in order to make that type of revenue? Well, as you see, each expense is listed very specifically here, and that's the goal of expenses, is you have to be as specific as humanly possible as to what you use the money for. Okay. I hate the term miscellaneous expense. I know some businesses use it. I hate it because how can it, if you can't come up with a way to classify it, I think you should sit down and think about it some more. Really, really. So I have a little question here. All right, revenue. Okay, so revenue, as you know from, and this is just a review here. Revenue is the amount that you earn from selling a product to a customer or performing a service for a customer. So, for example, if you went into your local 7-Eleven or Stewart's and you bought water, a bottled water from them, that money that you paid for them for the water, say it was $2, that's the revenue for the store. So that's their revenue. They sold you a bottled water for $2. So Sierra Corporation does tours. So whatever they sell tours for, let's say you wanted to have a tour of the Sierra Nevada and it was $50. Well, that $50 you paid for your tour is their revenue. Okay, is their revenue. All right. So I hope that helps a bit, which is good.
I have a
Always good to.
question.
Yes, go ahead.
So if like you have a company that sells stuff and you sell stuff and you have tax, is the tax included in the revenue? That's expenses, right? The sales tax?
Uh, the sales tax is it's not part of revenue, no.
Okay,
And
so it's expenses.
it's not an expense, no.
Oh,
For businesses, so you go to your local McDonald's and you buy something from the dollar menu. I don't even know if one exists anymore, but and here in Dutchess County, you pay $1.08, right? So it's $1 for, say, a small fry and 8 cents for its tax. The company is going to collect $1.08 in cash. So they're going to show they collected $1.08 in cash. But $1 of that is their revenue. The other 8 cents they collected is a sales tax that they owe to the state. So it's going to be called a sales tax payable.
so it's a liability.
It would be a liability for them.
Oh, okay, thank you.
You're welcome. Okay. All
And
right.
I also have a question.
Yeah, sure.
So that same water bottle scenario that you were talking about earlier,
Yes.
if it costs $2, but it costed them $1, is that just profit that they made and it's not the actual revenue?
Well, we try to separate things into one little thing at a time. So the selling of the bottled water for $2 is their revenue, and that's all we're looking at here. Now, when we get into chapter 5 and chapter 6, we're going to be looking at merchandising. And merchandising companies, of course, are any retail store. Retail stores, as you might know, they have to buy the products and put them in the store first before they let the customers come in to buy them. So yes, they will have a cost of goods sold once they sell it to the customer. Yes, but we'll deal with that in chapter 5 and chapter 6.
Okay. But that has nothing to do with like revenue, does it?
The revenue is simply what you're selling, not
Okay.
not how much it costs you.
Okay, thank you.
Okay. So, and I think these are good questions because I think it helps people focus a little bit that it's really important to get the definitions down of these terms as to what they really are. And if I can help explain things again, that's what I'm here for. But again, the revenue is what you earn by selling something. It has nothing to do with what it costs you. It's simply what you earn by selling. We will deal with that in a separate issue. So again, whether it's $2 for a bottle of water or $50 for a tour, whatever you're collecting from the customer is your revenue. All right. So for Sierra Corporation here for the month of October, they made $10,600 in total revenue. But obviously they had to spend a little bit of money to make that money, right? So anything that they needed to spend in order to make their revenue is what the expenses are going to show. So in a service business, or a service business is where they're not selling you goods, they're actually providing you with services. So they're providing you something. So, for example, Sierra Corporation is a service business. They solely provide tours of the Sierra Nevada region. They don't sell you any product. They simply give you a tour. So that's a service. There's a lot of service businesses. All hospitals are service businesses. They're there to serve, provide services. Law firms are service businesses. Accounting firms are service businesses. But so are people that plow snow. That's a service business. People that provide um, haircuts and styles. That's service. Um, you know, those it's work that you're paying for someone to do for you. Service businesses rely on labor. Everything is about labor. And so the largest expense they're going to have every single month is paying people to do the work. And once they pay people, that's a salaries and wages expense. Now, the expense means they've already paid them. Okay. So expenses really already happened. They kind of happened to make the revenue happen. Salaries and wages expense means that between October 1st and October 31st, this company paid $5,200 in total salaries and wages in that month. Most businesses, you might not realize or not, are they rent their shops, they rent their stores. Most doctors' offices are all rental stuff. The mall is 100% rent. Everybody in the mall rents their space there. A real estate company owns that and rents out those spaces. So, but of course, there are companies that own their own buildings. Now, that's not to say that they don't, but most companies rent, believe it or not. So every month they cut a check for rent. And guess what? They have to in order to have their store open. So that's a rent expense, right? Um, Companies like Sierra Corporation that do tours obviously need certain amount of supplies to help them carry out their business. So once they use up supplies, they can expense what they've used. They might have needed to purchase equipment to help their business. Equipment is a long-term asset for them. But as they use it, they literally can depreciate a portion of its value over time. And you're going to learn a bit more detail about depreciation expense, but that's sort of a very slow expensing of a very long-term asset like equipment or a building or something like this. Anytime a business has a loan, they pay interest on those loans. Guess what? The interest that they pay is an expense. That anything they pay for interest on a loan that they have can be expensed in the month that they paid it. So interest expense is here. And of course, they also have insurance. Every wise business, of course, will have an insurance policy to cover their liabilities for a period of time. And I do mean personal liability, negligence, and things that are legal in nature, in case a customer gets hurt or an employee gets hurt. Or their store needs to have insurance, or their vehicle needs to have insurance. When you buy insurance, you're buying a long period of coverage, 6 months or 12 months of coverage. So insurance actually starts as an asset because you're buying 12 months of coverage. But after you've already used a month of coverage, you can expense the month of coverage you used. That's when the insurance expense is. The total amount of all of these expenses is listed here, $7,740 of expenses were needed to generate the revenue of $10,600 for Sierra Corporation this month. The difference is the profit. Again, the formal term that we use on the income statement is net income, but net income simply is a profit. Profit happens when the revenue is larger than the expenses in the period of time that it's being measured. Okay. Who owns the profit? The owners. Corporations are owned by stockholders, right? So the owners actually own the profit. Okay. And so what happens to that profit is shown in the retained earnings statement. So here in the income statement, here you've seen that we created a $2,860 profit by calculating this. Now we're looking at what happened to that profit in the retained earnings statement. The retained earnings statement has the exact same measurement period of time as the income statement because it's telling you about the profit. So it's telling you about the same period of time, okay, that the profit was generated. Again, the word earnings means profits. The word retained means to keep in, right? So how much of these profits, this $2,860, is the company retaining, keeping in the company? And how much is it given away? Well, companies, this is a brand new company, so it does not have any previous profit or loss. So that's why this starts with a zero. It only starts with a zero once, the first month or year that it started. We're adding the profit that we just calculated, and we are subtracting the dividends. The dividends are a portion of the profit that we share with the owners. So it's actually going out of the company. It's not staying in, it's going out. So we subtract that out. So what is actually being retained of this $2,860 profit? The actual amount that's being retained in the company for the future is $2,360. Okay, so you're going to actually be preparing the income statement and the retained earnings statements for businesses.
I have a question.
In our book. Yes.
So let's say we were to like fill out a retained earnings statement. Where would we find the dividends?
In the beginning, they will give you the amount of dividends that you'll have.
Okay, thank you.
So they'll just be part of the information that they give you as part of the exercise. So nothing to calculate there, thank God, right? Okay. So whose retained earnings are these? Who owns these earnings? The stockholders do, right? The stockholders do. So that means that these retained earnings are going to show up on the balance sheet under the part where the stockholders are represented, which is stockholders' equity. But let's talk about the balance sheet as a whole, and we'll look at this specifically. The balance sheet, like I said, is a selfie, a financial selfie of a particular day, in this case, just October 31st. See how it differs from the other two statements, which were for the period of time, the month of, right? Balance sheets are a snapshot of what assets the company has on a particular day. Remember, assets are resources that are owned by the company, okay? And here you have a list of a few very common assets that a lot of companies will have. Assets are listed in what we call liquidity order, which means they start with cash and they're listed, the accounts are listed in the order in which they might turn to cash or they might be liquid. You'll get more detail on this in chapter 2. The cash is a specific asset account, and we don't necessarily mean cash like in people's pockets at the company. When we talk about the cash account, this is their main bank account, Okay, that's whatever you have in cash. Normally, most companies keep most of their cash in the bank. And so they might have some cash on hand in their stores, et cetera. That's also part of cash. But the main portion of cash that companies have are kept in their bank. So the cash account specifically is that. Accounts receivable, you were introduced to this real briefly in Objective 2 from your reading last time. An accounts receivable is you're waiting to receive cash from an account you've already done the work for. So an accounts receivable, you've done the work and you've given them an invoice and you're saying, yeah, okay, I'll wait to receive payment on this. Supplies they start as assets. Supplies start as assets, but once you use those supplies, you will turn that into a supplies expense. Prepaid insurance also starts as an asset. When you buy insurance, you're buying insurance for a long period of time, 6 months, 12 months, what have you. So it's an asset. Once you've used up the insurance, which usually we do on a monthly basis, we can expense the portion of the policy as insurance expense. Equipment tends to be listed last because it's considered a long-term asset. We're going to be using this equipment for well over a year, oftentimes many years. And so equipment is often listed quite last. Equipment is used over many, many years and thus is subject to something called depreciation. And that's a very, very slow expensing of that asset over a long period of time. Okay, and there's more information on that in Chapter 9. Notice you have total assets of $21,910. So the assets are the very first part of the balance sheet. Now, the interesting about this, the balance sheet has to balance. The other side is two major types of accounts: the liabilities of a company, right, the debts of the company, what the company owes, and the stockholders' equity of the company, right, what the owners actually have on the assets. And I need you to think about the fact that your total assets here are going to equal your total liabilities and equity. And I think it's a very reasonable thing to think about. Remember, we talked about financing activities. If you wanted to buy a $10,000 car, you would need to have $10,000 of financing. And so the same is true for a corporation. If a corporation has over $21,000 of assets, it's going to need over $21,000 of financing. Liabilities and stockholders' equity accounts are generally financing. Where is the company getting the money to finance its assets? And so liabilities are listed first. These are general debts of the company. Both short-term and long-term debts are listed. They are listed in that order, in fact. The short-term debts are listed first. Long-term debts are listed last. This particular company, being a new company and a very small company, has several liabilities. All of them are short-term, as you'll come to know in next chapter. We've already talked about a note and a note payable. So a note basically is a loan. So they certainly have some type of a loan. And most of these notes are short-term, meaning less than a year. Accounts payable simply is any bill that's due in 30 days. It's an accounts payable. They also have a couple of other payables like salaries and wages and interest that are due in the near future. One account that I really kind of need to ask you to pay attention to doesn't have the word payable in its title. Notice how the other four accounts have the word payable as its part of its title. This is something called unearned service revenue. And it's actually a very common type of account in businesses, period. Unearned service revenue simply means the customer has paid you up front and you owe the customer whatever they paid for. That's why it's a liability, because you owe the customer. So in this case, Sierra Corporation has collected $800 from people who they owe tours for. Remember, because Sierra Corporation sells tours. So when people give them money up front, they're paying for tours up front. So the reason it's a liability is because they owe them the tours. This is actually quite common in like the travel industry, the entertainment industry. They'll have a large account of unearned revenue. So for example, if you pay for a trip, whether it's a cruise or a package, a flight, hotel package to Florida or someplace warm, usually you pay that up front, or a good portion of it up front. That's a liability to the company. They owe you that trip. They owe you that cruise. Same thing with sporting events, concerts, things that you're paying up front. A lot of people buy season tickets, or they'll buy tickets for a concert for several months from now. When the company gets that money for selling you those tickets, they can't say it's theirs because they owe you the concert. They owe you the sporting event that you paid for. And so they put it in this account as unearned revenue, as a liability, because they know they're going to owe you a concert, or owe you, a hockey game or a basketball game or whatever you paid for. So it's a very, very common liability account, and you should know what it is. Total liabilities are listed to the far right, as you see here, as our totals are. Stockholders' equity, there are only two accounts in stockholders' equity. One account we talked about in the last statement, retained earnings, is the amount of the profit of the company that has been retained. And I asked you who owns the profit, and the owners own the profit. Well, this is the section that shows the owners. Okay, so the retained earnings here comes from the retained earnings statement. Okay, this is the amount of the owner's profit that's retained. Common stock is the shares of ownership. That's also represents the owner's interest in the company. So this particular company has $10,000 of common stock because that's how much they sold to get to raise money to start the company. Notice that the assets equal the liabilities and stockholders' equity. So your total assets will always equal your total liabilities and stockholders' equity, always. And that's because this is a very important equation. We call it the accounting equation. It is the balance sheet equation, but it's more commonly known as the accounting equation in every textbook I've ever seen in almost 30 years now. Assets equals liabilities and stockholders' equity. You need to know this. This is a very, very, very important formula to understand. This is how the balance sheet works. This is how accounting is going to work in the long run. Okay, and this is, again, how you would set it up. You're going to be preparing these. The statement of cash flow, again, we're not preparing it in this section, but it's introduced. And it talks about those activities. We talked about learning objective 1, right? Financing activities, investing activities, and operating activities. These activities either provide the company with cash or use up cash in the company. So they're either going to provide, so a positive number here means they're providing cash. The negative numbers here simply mean they're using cash, because only this statement looks at cash, nothing else. And so what you have is you have no cash at the beginning, but you have $15,200 cash at the end based on everything that's happened. This happens to be the exact same balance in the cash account on the balance sheet, and that's how they're connected. But again, you don't have to do these, you just have to, you're just introduced to it right here.
So
right. Yes.
if a number is in parentheses, does that mean it's negative?
No, it just means it's a use of cash.
Okay.
In accounting, there's no negative or positive, and you'll get to know that when we get into chapter 3.
Thank you.
Yeah, no problem. So do it exercise 3A is what your homework is going to be roughly about, is actually going to be preparing financial statements. And again, that word prepare means that you got to put time into it. This is not rocket science that I'm asking you to do in accounting. It's actually quite practical and important to know. However, it's time consuming, which is why I keep putting this course is time consuming on almost every announcement I had in the very beginning of the class, if you've read them. It's in my welcome message. It's in the first announcement, and I'm going to continue to say, this is a time consuming class. Again, I don't think it's very difficult to put an income statement together, but it's going to take you time. Income statements are always the first thing we put together. And there's a whole bunch of accounts on here that are listed for this company, CSU. They're a brand new company because they started on January the 1st. And now everything is this. They want you to prepare these for December 31st, the end of its first year. So to do an income statement, you have to know what goes on an income statement. Income statement always starts with revenue. And what comes after revenues? Expenses. And there are 3 expenses that are listed. So these are the only accounts you need to know to do the income statement. Okay. And once you know that, then you'll be able to put an income statement together. The income statement looks like this, right? Your service revenue, $17,000. You had 3 expenses. They were listed. Now your book tends to list things big number to small number. Don't worry about it. As long as you actually have all of these accounts identified and listed, you're good. Total expenses of $10,200. Again, this is a very happy book. All the companies in this book in the first few chapters are all profitable. I only wish that was the case in the real world. And so you have net income of $6,800. Okay. So that's the first thing that it does. The second thing we have to do is a retained earnings statement. And the retained earnings statement, right now, all you see is a question mark here. And that's because this is a brand new company. And this is the first time they're doing statements. And so you're going to actually be able to figure this question mark out. Now, what does it take to figure it out? Well, we need to know what the profit is, which you were just did here. Net income was calculated here on the income statement. What else do you need to know on a retained earnings statement? Dividends. Dividends are there. So now that you know what information you have available to you, and this is a brand new company, you can see that the retained earnings statement starts with a fat 0 at the beginning of the year because it's a brand new company. We add in the net income that you just calculated. We subtract out the dividends, which are given to you. And the retained earnings at the end of the year is $6,200. This is an important number because this is going to be moved over to the next financial statement, which is the balance sheet. The next thing you have to do is prepare the balance sheet. The balance sheet has starts with asset accounts, right? The assets are first. So when you look at your list, you have to pick out the assets. So accounts receivable is an asset. Equipment is an asset. Supplies are assets. Cash is an asset. Those are the accounts that are assets. So those are the ones that are going to be put first. You're going to total those up. Then you're going to look for the liability accounts. What are the liability accounts? Well, accounts payable is a liability account. The notes payable is a liability account. Those are the 2 liability accounts that you'll have. Nothing else is done. You already used the expense account, so you're not going to use it. You already used your dividends account, so you're not going to use it again. You already used your revenue account, so you're not going to use it again. These accounts belong on specific statements. Once you've used them on that statement, you're done. You're done with that account. You're not going to use it in another statement. Okay. And that's not an overstatement. I got a smile. Might be an understatement for some. Oh, another smile. Oh, he's too corny. Shut up. Okay. The other part of the balance sheet is stockholders' equity. Common stock is going to be listed. And since you already figured out this question mark, that's going to be listed too. So your balance sheet is going to look like this. Your assets, cash, receivables, supplies, and equipment for a total of $23,200. Liabilities are listed and totaled. stockholders' equity accounts are listed and totaled, and this total up to 23,200, and you're good to go. Your homework is going to be a lot like this. Okay.
How did you get the retained earnings again?
Right from the statement that we did before. Right here, retained earnings statement.
Minus the dividends. Okay, thank you.
So that's where we're getting that number from. Okay. The chapter ends with a little bit of news on the annual report. So the annual report is very important, certainly for corporations that are publicly traded. So a publicly traded corporation is a corporation that you hear about on the news because it has stock on the New York Stock Exchange or the NASDAQ. Again, those are companies, those are called public corporations because anybody in the public can simply become a stockholder by buying a share of stock. Okay. So because these are publicly traded, there are certain laws that the government has placed on them to make sure the information is reported on a regular basis publicly. Okay. And the big kahuna of those reports is an annual report. It's a very large report. They do have to do quarterly reports and other reporting, but this is the big one. And what they show is the financial statements for the year. You'll see all the financial statements that we just went over in this part of the chapter listed there. There will also be notes to the financial statements. Actually, this part and this part actually go together in an annual report. And those notes will describe a little bit more about what some of those numbers mean or what methods they use to calculate those particular numbers. Okay. The biggest part of an annual report is what management has to say about the company. And so the management discussion and analysis is a huge part of this annual report. They can be, I mean, the entire annual report itself can sometimes be 100 pages or more. The management discussion analysis is a good chunk of that report. And then the last thing the report has to show is that the financial statements have to be audited by an independent accounting firm to make sure that these financial statements are following the rules of financial accounting, which are called GAAP, Generally Accepted Accounting Principles. You'll learn more about those in chapter 2. But the auditor's job is to make sure these statements are presented according to the rules and they're presented fairly. Your book goes ahead and shows a little bit more detail on this. The management discussion analysis is quite big because it's really about management's view of the company. They have to make sure they're telling you about favorable and unfavorable trends, some significant events and uncertainties that might affect the company. They have to disclose all of that. Financial statements often will have notes to explain exactly how they calculated certain things. And the auditor's report, again, will be done by a certified public accounting firm because they have to make sure that the report is fair and that the company is following generally accepted accounting principles. This is what GAAP stands for. It's an acronym, Generally Accepted Accounting Principles. And you're going to be learning a little bit more about these in this course as we go. Okay. So that really is the rest of chapter 1 in terms of what it looks at. The heavy lifting here is focusing on those financial statements. And a lot of good questions, which was good. So any more questions now that we're done?